Okay, everyone, we're running a little bit behind now, so we're going to get cracking. It was great to see, though, after the fintech panel, the number of discussions going on at the side of the stage and still going on at the back of the room, which is always great to see. We've been covering some fairly chunky, hefty, and important topics during the course of today, but I doubt if there's a more important one for all of us, both in terms of development of financial markets, but indeed the world that we live in, than the one that we're about to have on transition finance. And it is going to stay focused largely on the concept of transition finance rather than the broader sustainability ESG questions that maybe some of these panels get involved in. I am delighted to be joined by George Lamb, who is the chair of the United Nations Economic and Social Commission for Asia and the Pacific Sustainable Business Network. Welcome, George. By Leslie Maasdorp, who's Vice President and Chief Financial Officer of New Development Bank. Welcome, Leslie. By Gabriel Wilson-Otto, who is Head of Sustainable Investing Strategy at Fidelity International. Welcome, Gabriel. And by Han Shi, who is the Head of ESG Center at the University of Hong Kong. Let's just start by defining what we're talking about. What is transition finance? Han, do you want to start us off on that one?
Transition finance has sort of very often confused with the green finance, and transition finance particularly focused on those business industry which has a cleaner goal to transition to low carbon sort of economy. So basically you can, but environment, green finance more looking at those projects with clear environment goals, including not only the climate change, but other aspects. So basically you could say there's a big overlap between them, but there are also special aspects like transition finance in Chinese cases will support those coal-fired power plants to actually have, more cleaner use, including also looking at those high carbon intensive iron and steel production process, which actually transition towards the in the Chinese cases, transition finance even has more demands compared with currently at least the scale compared with the green finance. I just give a little bit like this startup.
Thank you, Han. George, same question to you.
Well, I think nowadays we talk about the green finance market with focus on dark green. So the various shades of green, right? Dark green projects are classic, backed by, for example, green buildings, renewable energy, and so on. But they are not the mainstream. They're not the largest cases. They are a good niche growing, but we need light green as well. So how to actually enable for example, polluting industries, companies to do something incremental, but contributing to greening the planet, so transition finance is bigger, wider in scope. And I know institutional investors and lenders, of course, sometimes they are not allowed to invest in anything light. Well, dark green, for example, is the focus. But I think most of the investors would welcome a widening of scope so that, they can, have more investment opportunities, at the same time can contribute to the goal of protecting the earth. Don't forget, today is 2023. Which is a midpoint of the 2030 agenda for sustainable development. And in Asia, we are now only 15% overall in terms of accomplishment of the 17 sustainable development goals. And in one SDG in particular, SDG 13, which is climate action, we are regressing. We are not making progress. So anything that we can do, we should. Transition finance, yes, let's go for it.
Thank you, George. Well, we'll come back to some of those issues. Gabriel, let's go to get the investor point of view on this. And you're head of sustainable investment strategy. So you're making calls on where one of the world's biggest fund managers is allocating its funds in this whole broader ESG sustainable base. What is your approach, and particularly what is your approach towards transition finance?
Sure. So if we're looking at transition finance, we can break it down into relatively simple terms. If we're looking at products that are already green or assets that are already green, they're not transitioning, they're already there. They're at the stated aim and the objective of where we'd want them to get to. When we're talking about transition, it's effectively assets that may not have all the characteristics yet that we would aspire the management of those assets to get to, but where we can see a defined strategy and plan to achieve that level of greenness or quality of our operations. So when we're thinking about transition, it can be through the products and services that you offer. So if we think of power generation, there is a spectrum of carbon intensity. It can also be through how companies operate in terms of trying to improve their own carbon efficiency to move towards a net zero pathway. So within our portfolios, we've developed a climate rating tool, which actually provides 5 buckets or categories of where companies sit on that pathway towards being net zero aligned. What that allows us to do is to both create funds off the back of it, but also to use it as a tool for engagement with corporates to try and move the needle on driving decarbonisation or improvements in operational efficiency from investee companies. So that's the big picture framework, and one of the tools as to how we can drive it.
Can you explain a bit more about the 5 categories? I mean, is one category brown, we don't touch it, to dark green, it's okay, and it's all the juices in the middle, effectively?
So one way of framing it, if we look at the bottom category, it's effectively no evidence of transition, whereas the top category is completely aligned or achieving net zero. The next one below that is aligned to net zero. So you've set the right targets, objectives, governance structure, CapEx goals, but you may not yet be delivering on those targets. If we go down to the next category, it's high evidence of transition. So some of those pieces are in place, but they're not really there. So we're looking at potential for ambition to be increased. And then again, that phases down from low evidence and then no evidence of transition. There's a scorecard that sits behind this to put some numbers and rigor around it. It's not just a qualitative assessment purely. But for me, this is actually a really important tool, but important concept around Asia, particularly in driving dollars towards real world change and actually trying to encourage that transition. Because we can't just tomorrow say, let's only support dark green renewable energy companies. We need to look at the reality of the markets and the development of the grids and the economies that we're investing in, and find out what's appropriate and how that can be dialed towards the beneficial long-term outcomes.
One of the things I've heard from other investors is that there is no shortage of money for dark green anyway. So it's not a problem needs fixing. It's the other categories as you describe them. But I just wondered whether you can tell us, either from a global or Asia perspective, what proportion of the companies and organizations that you rank fit in each bucket, because that'll give us some idea of the path we need to go down.
So it's not a complete barbell. Effectively, if we look at a good proxy for this using public data is if we look at the EU taxonomy, it's effectively a dark green catalogue of activities. What it shows for the world is that we're at about 2% of companies are aligned. If we look at Europe, which is where the framework was designed to be implemented, you're at closer to 5% of companies. For our framework in the dark green category, it's similarly low single digit, as you would expect. There's actually a significant number of companies in that low or high potential bucket. So this is the middle bounds, and in particular in Asia. And for me, this is really reflective of a lot of the national commitments that we've seen over the last few years. It's also reflective of the increasing economics of shifting towards low or decarbonising a business's operation, but it also reflects the complexity of getting there tomorrow, in that in order to actually have a business model entirely aligned to net zero today, or be delivering that, is a very, very high bar for businesses, especially if you're in a hard to abate or industrial sector. If we look at Fidelity's own operations, it's actually relatively easier for a company within a financial services place to decarbonise operational emissions. So we have a net zero commitment for 2030 for Fidelity International's business operations. But the real world impact from what we do as a firm is really from the investments that we make and how we can influence the allocation of capital and performance of those entities. And that's where we're looking at 2050 for net zero.
I was just going to ask you, what's the time frame that you're looking at? What are the goals that you're setting those companies that you're looking to invest in?
So at a high level, we have a firm level commitments, which I just outlined for Fidelity International. For our investee companies in our entire portfolio, we're looking at halving the carbon emissions of our invested portfolio from 2020 to 2030. So over that period, contributing our fair share of carbon emissions reductions, which is that targeted 50%, which puts us on the pathway towards net zero. As part of that as well, we're also a signatory to the Net Zero Asset Managers Initiative. And under that, we're looking at putting around a third of our assets onto a net zero pathway. So these are entire portfolios that are managed with specific targets in order to be on that exact glide path.
Thank you, Gabriel. Leslie, New Development Bank is a new type of development bank. You're focused very, very largely on this space of sustainability, transition finance, green. That's the majority, I think, of the loans that you make will fulfill those criteria. How are you viewing the transition finance part of what NDB does compared to maybe other bits of the green sustainable spectrum?
Sure. Thanks very much. I think the first point to make is that as a development bank, we are anchored in emerging markets. We are owned by Brazil, Russia, India, China, South Africa, and we've had a few new emerging markets join the bank: Egypt, Bangladesh, United Arab Emirates, and Saudi Arabia is about to join. So the element that I want to bring into the conversation now, Clive, is around what we would call the just transition. The concept of the just transition emerged around sort of 2011, 2012, but it was captured in the Paris Accord in 2015. And essentially what it says in short is that we are not at the same sort of, or the historical starting points, if you like, of emerging markets versus the developed world are very different, right? As we embark on this decarbonization process towards net zero 2050 in aspiration, it is not a sort of zero-sum game, or put it differently, the developed world industrialized during a time where carbon and fossil fuels were not really an issue. In the United Kingdom in the 1800s and 1900s, United States and so on. Africa, let me make it very real for you. I come from South Africa. The entire African continent, north of 1 billion people, contribute 3.8% of global greenhouse gas emissions, 3.8%, 1 billion people. So as we focus on decarbonization, China, for example, is 28%, Europe over 20%, and so on. Many of our countries do not have power today. So, think about babies being born in, rural DRC where there's no power, or a poor African country like Madagascar. A lot of these countries have coal. Do we stop or slow down the process of industrialization of those countries because they will be, embarking on utilization of brown and fossil fuel intense industries? So the key point is this: as a bank and as multilateral development banks, we give a huge prominence to this idea of a just transition, meaning we need to ensure that we put plans in place, that there is training and retraining of workers, that, for example, where there's stranded assets, where workers lose their jobs, where entire communities face prospects of ghost towns. I'll give you one concrete example to end off on your first question. South Africa have one province called Mpumalanga, where 80% of our coal-fired power stations are located. Many of those power stations are reaching the end of their lifespan by 2030, 2035, 2040. Those will become ghost towns unless we retrain workers, build new renewable energy industries, green hydrogen, and so on and so on. So it is not just a matter of enabling financial and capital markets to provide transition finance, but we need to recognize that there are particular unique concerns of emerging markets. And that's the focus of development finance institutions.
So there has to be a social aspect as well, right? It's not just the sort of like, the almost when you go and choose your paint color, see which one you're going for. You have to have a social aspect to this as well.
And also, I think important to mention, Clive, is that there is a process, for example, that we need to take into account where, let me put it differently. Europe is kind of the climate heavy hitters. Europe is way ahead of everyone else. However, some of the policies that are in place, been put in place, like the carbon border adjustment mechanism, will lead, we believe, to potentially new forms of trade tensions, because Now, if we as South Africa export goods to the European Union, there'll be an additional tax imposed on the basis of the carbon intensity of those goods that we export. So we then become more uncompetitive, which means jobs are destroyed. Again, I'm flagging the issues that the concerns of developing and emerging markets have to be center stage as we design appropriate policies as part of the decarbonization pathway.
Well, let's talk a little bit more about policy, but I want to get onto products shortly. But just on that, I mean, we talk a lot about green bond frameworks, sustainability frameworks. Does there need to be a transition finance framework? We know I've seen the UK Treasury came out with a plan that they hope might get some traction. You see some of the big Canadian pension funds really quite active in this area, trying to bring asset owners and asset managers along. Is a common standard framework achievable or desirable, Leslie, given that, you know, what you said, you know, different parts of the world might need a slightly different approach? Leslie, you go first on that.
Sure. Very briefly, we are definitely on that path. I think this started already pretty much after Glasgow, and the work that Mark Carney has done in leading that effort has been really quite extraordinary. There's a number of processes underway to ensure that there's greater convergence of standards, greater convergence in taxonomies, but it will take time, as you say. But the aspiration and the ambition is there. Out of Glasgow and going over the last 2 years, as you know, the International Sustainability Standards Board have started their work. They know well on the path of establishing their offices and their capabilities and so on. But they will be issuing new standards that will become, you know, someone has likened this to, you know, early 1930s when general accounting standards were introduced. We are going through a similar process now of, you know, economy-wide shifts. And, you know, we'll find new impact accounting rules. Ron Cohen, who's one of the fathers of impact investment, together with Harvard University, they're drafting these new accounting sort of rules where essentially, even if a business is profitable, you need to impact on your carbon footprint in your accounting metrics. So all of these, the outcome or the net result will be a new set of standards that will guide business. And we are, you know, sort of at the early stage of that transition. We are not even, you know, in the middle of it yet.
But we need to get on with it, I think.
And it will affect, finally, Clive, it will affect fundamental concepts such as core concepts that you learn in finance. A few professors of finance here, how you look at risk return. Stranded assets needs to be factored into valuation metrics. So everything that we know in modern finance has to be subjected through a new lens based on the sustainability agenda.
Thank you, Leslie. George, what's your view on frameworks for transition finance?
Yeah, I think just now Leslie summed up very well. I think taxonomy and standards and, you know, everything are important because we need to scale up and speed up the deployment of capital. But I think we need also quality, good quality data. Otherwise, there's no transparency. And of course, the just transition issue has to be dealt with, particularly in Asia Pacific, because Asia Pacific accounts for more than half of the global greenhouse gas emissions. And in 2021, that was more than double, you know, compared to 1990. And so Asia Pacific is high growth and also will be subject to a lot of negative impact, including heavy precipitation and also drought and everything. So the battle against climate crisis has to be won in Asia Pacific. This is where it matters, you know. So I think we need to do a little bit of that work so that we can take Asian matters into Asian hands. You know, I think the European standards are very good reference and framework. But I think we need to do a lot of groundwork here to make sure that we have standards that are pragmatic and, you know, can cater to various stages of economic development in emerging markets. So I'm very optimistic, but I think, for example, the public finances can be deployed in transition projects. We have all sorts of sovereign funds and state-owned enterprises with lots of cash. And I think that strategic investment.
We'll come to that in a second, George. That whole public-private partnership is very important. But Ham, from your point of view, have you been studying some of the proposals around frameworks in transition finance? Do you think an Asian or Hong Kong or Chinese framework is the way forward?
Of course, different countries will have its own sort of priority in how to sort of, more appropriate or more efficiently actually to promote that transition. You can see there are nuance differences, but I think Hong Kong can play a very, very important role. On the one hand, China is the biggest market for transition finance. If you look at that, as we said, China has emitted 28% of the greenhouse gas emission, but also the huge industry stock. That's heavy industry based. On the other hand, if you want to actually attract such a big, huge amount of investment, that those cannot be all coming from domestic sources. So international sources will be very, very important. So how actually you can overcome some of actually the investment concern. So Hong Kong can sort of align both the international best practice in finance, transition finance, with China's own development priority and situation. I mean, that particularly the bridging role, I think you will, if China got, the biggest market for transition finance can effectively actually link with the international financial market. I would say you will create a huge, I think the best, kind of, experience as well as, actually the approach the other country can look into. So I truly believe Hong Kong should play a very, very interesting, important role.
I'm sure we'll come back to a little bit of that in a second. But Gabriel, from your point of view, interesting, the ISSB, I believe I'm right in saying those are equity market related disclosure requirements rather than debt market related. I believe that's correct, but tell me if I'm wrong. But who enforces? I mean, in the end, it's going to be the investor and whether they buy or not who's the ultimate enforcer, or is it going to be the exchanges are going to sort of like follow these accounting procedures in the way they would do signing off your annual accounts? Where does the power lie in that equation?
So for ISSB, very shortly, massive fan and supporter of it in terms of driving a consistent framework and architecture for disclosure, but then also with some of the SASB metrics and others, either metrics within their own house or by making reference to international standards to drive convergence, both at the data and at the reporting level. This isn't just isolated to an equity market participant for disclosure, but your question as to how does it get enforced? What are the actual levers for driving disclosure here? One of the interesting areas that we're seeing is that there has been a lot of support within Asia Pacific and particularly within Hong Kong around the adoption of some of these standards. So there's a general disclosure framework and a climate disclosure framework are the two papers that we've got currently. There's also a consultation out at the moment for where they should focus next. And this includes areas such as biodiversity, human rights, labor, supply chain, a few other topics. So we're going to see a more complete set of standards on the disclosure. What I like about it is that it's focusing on a high-level framework for governance, as well as the underlying strategy, implementation, and metrics. So similar to and apologies, you can't talk about sustainability without 100 acronyms, but the Task Force on Climate-Related Financial Disclosures, or TCFD framework, is one of the guiding documents that ISSB are basing their standards on, is from an optics perspective. And what we're seeing is that the climate part of that disclosure is actually very aligned with a lot of the initiatives and disclosure requirements that have been rolled out through Asia already. So from my perspective, I would expect more rapid adoption of that, with mandated requirements coming in from exchanges across the region to enhance climate disclosure and reporting to be more consistent with ISSB's recommendations. The other element is that we are seeing push from IOSCO and from other organizations towards these sorts of initiatives, which is, again, another force for harmonization and standardization of some of the disclosures. why this is really important. Like I clearly get too excited about sustainability data and regulation, but why this actually matters, to sort of bring it back to something tangible, is that if we look at a transition framework, for example, or trying to say, how do we measure performance of a corporate in China and how can we provide them with capital as an international investor? The first thing you need is an evaluation and assessment of that company. If you want it to be scalable and you don't want to go to each asset yourself and do all of the due diligence and measurement and reporting, you need the company to be reporting data in a standard way that you can consume so that you can do scalable analysis. The next step is at the framework level for interpreting that data. So being able to say, okay, we've got the data point. Does this classify as transition or green within my own personal framework as an investor or within the market within which I operate? And so that transition framework, as well as some of those data points, are still the missing gaps here in order to be able to scale development towards it, which is one of the reasons I think ISSB could provide the data layer. But the question remains on that middle layer as to whether you get a consistent view on transition.
And just to finish up on this with you, Gabriel, those jurisdictions that apply and enforce more than others for a big global money manager like Fidelity, those jurisdictions will benefit from inflows of capital accordingly, do you think?
I think that we're already seeing it. So if we look at, and apologies again, so within Europe, the Sustainable Finance Disclosure Regulations, or SFDR, has created different categories of disclosure for different funds. What we're seeing is a huge flow of capital towards the darker green versions of funds within that framework, without getting too technical on the classifications. What that has led to is some investors in Europe literally saying, I will not invest in this fund unless it meets these minimum standards and minimum criteria. So we're already starting to see a greater level of differentiation between different characteristics, whether this is disclosure, whether this is ESG score, activity involvement. It's starting to move more capital. Longer answer on that, so I'll hold myself back. But it's related to the transition topic and whether it's ownership or divestment is more appropriate. But that's effectively what it's leading towards. Is that problem?
We might have time to come back to that. I sometimes get frustrated on conversations about sustainability. I'm saying this to George just now. A lot of talk about policy, but actually what you need a product. I mean, that's effectively, there is a huge amount of financing to be done, and there probably aren't the tools or the capability to do it right now. So let's explore a little bit about where that product might come from. Leslie, I'll just come to you first. Obviously, there's a lot of talk about MDBs, the loans that they make, and the ability to maybe make those loans go a lot further with the co-investment from other public sector participants or private sector or asset owners. How are you viewing that part of this discussion?
Sure. I mean, I'd say that, over the last few years already, there's been, a fairly heated conversation about how multilateral development banks can be more effective, meaning can optimize their balance sheets more and sort of really magnify their impact. And right now, this is coming down to our core operating model, coming down to our products. What do we actually deploy, and how can we better use, for example, make use of instruments like guarantees? If you think about it this way, multilateral development banks are some of the biggest providers of climate finance today. But as a system, we're actually quite small. I mean, all of us, the institutions, World Bank, Asia Development Bank, European Investment Bank, combined, the total assets is about $2 trillion. If you look at the institutional investor community that Fidelity is part of, that's pools of $130 trillion. So we are tiny dot within the overall scheme. However, we can play a more catalytic role and use our financing in such a manner that we can mobilize more private sector funding. So we are completely focused now on that agenda. We are no longer looking at just growing our own balance sheet via making loans to state-owned enterprises and building new renewable power and battery storage and so on. We're now looking to find ways to do more effective private capital mobilization and to be more catalytic. So creating climate funds, for example, HKMA have been, and I see some representatives here from HKMA, have been very effective in working with institutions like the IFC, EBRD, setting up multi-billion-dollar climate finance. I'm sure Fidelity might have the same. Amundi and other asset managers has done that too. That is what we want to do, to use our capital in such a way that instead of making a $1 billion loan to a country, that becomes more a $10 billion. Our 1 billion can generate 10 or 15 or 20 billion. And in that way, we can enhance our impact on the green transition.
I guess it's hard to know at this stage what that multiplier effect might be.
I mean, I'd say the first point to make is that multilateral banks are already very effective in that sort of leveraging sense, because we have a small amount of paid-in capital equity. We are effectively able to leverage that by raising funding from institutional investors like the ones who are in this room, by issuing bonds at a very cheap, at low cost of capital because of our very high credit ratings, and we're then able to on-lend those funds for sustainable infrastructure. So the model is already very effective. What we are saying here today, Clive, is how can we become much more effective as multipliers of development? And the shift away from lending to government, state-owned enterprises towards private capital mobilization is really what that shift is about. And I think we are very inspired by the current changes that's taking place in Washington, D.C., where there's a new leader, the helm of the World Bank, and he has put this at the center stage of his agenda going forward, changing the business model, looking at new financial instruments. So there's a sea change happening in the way that we look at our core business.
A former CEO of Citigroup in Asia, I think, if I'm correct. Yes, yeah. George, what about this whole public-private sector partnership angle and the ability to mobilize and create product that might get us some way towards this number we need to hit?
Yeah, I think PPP, for example, has been practiced for some time, and also has met with a lot of criticism from the private sector. For example, too much risk is piled up on the private sector and not fair enough or optimal. So I think the PPP is art and science in progress, right? China is doing a lot there, and particularly with the developing market. So I think through development banks cooperation as well. From Hong Kong, I think we can see Hong Kong's strategic role as a hub for promoting and facilitating regional cooperation. For example, in green tech innovation, we have about 200 green tech startups that are very innovative, and they should not just aim at Hong Kong and the Greater Bay Area nearby. They should export their solutions to the Middle East and Southeast Asia and so on. And that is where the impact is. And then I think the public sector and private sector interact there beautifully, because we are creating an ecosystem and clustering effect for the green tech companies and the green finance company. Recently, I think June 16 this year, the first meeting of the Green Tech and Green Finance Development Committee of Hong Kong was held, and we can see that the public and private interaction should drive the whole transition faster. I think a lot of ideas there, the synergy is there, and we see new products like smart metering, smart building solutions, and also AI-driven monitoring and so on, ESG data, anti-greenwashing solutions, hundreds of them. So I think this is where opportunities can be found. The other thing is, as I mentioned earlier, public money should be deployed in sustainability area instead of making investment in commercial real estate or whatever, or stocks or whatever. I think some money, significant money, should be deployed in green transformation and digital transformation, and they go hand in hand. So I think I'm very hopeful that in Hong Kong, for example, we have recently set up the Hong Kong Investment Corporation, which aims at strategic investments. I think countries around the region are doing just that and can become the catalyst and leader for more private sector to co-invest in green transformation. I think out of the many challenges ahead, I can see that this is where multi-stakeholders collaboration is needed, and Hong Kong, for example, can play that role. Along with Singapore, I think the regional hubs should work together to really get the entrepreneurs working together to come up with greener and smarter solutions. Because otherwise, we cannot achieve the green transformation objective anytime near our expectation. According to the UN research, we are going to miss all the targets of the 2030 agenda. I think, and how big is that missing gap? A couple of decades, several decades. So that means the 2030 agenda for sustainable development is now just on paper. I think to move forward, we need collective efforts, and we need leadership from the private sector.
Thank you, George. Those are decades, obviously, we can't afford. Han, where a lot of money needed, where's it going to come from?
Printing. I think of course, create a bigger pool of that. I understand adding a little bit like a development bank's role, because I personally participated like about 30 years of development aid projects in China, looking at, and one of those international organizations can play is really to help enhance the institutional capacity of the recipient countries. So actually, that is very critical. Not only you'll be able to create a more favoring, more attractive, institutional environment in order to allow those financial resources to be applied more effectively, but also what is very important is better how to match your own needs with the potential sources. This is really, I sort of, at the very beginning, 20 years ago, I'm looking at that. I think there's a big sort of mismatch between those donors and the recipients, because donors, they think, I give you something, I'm teachers, I'm sort of found the recipient side, actually, they are not in a position which, actually match, sort of the best able to use those kind of resources. So I would say, first of all, how we can make this very relatively limited financial resources more effectively. I think this is a huge potential for that. But also, I think there are many ways to try to enlarge the pool of the resources, as I said.
Gabriel, just on this question of products, it feels like we know what we need to do, but we don't know quite how to do it yet.
I think that one of the key challenges here is the complexity of what we're suggesting and ability to do it at scale. And so if we look at catalytic capital, I'm personally an absolute massive fan of that. I think it's a brilliant way of getting that alignment of interest, either de-risking an asset, providing an appropriate return, appropriate guarantee, or even on-the-ground expertise and execution of a product which a institutional global investor may not be able to bring to the table. So that can really crowd in a huge amount of investment. Part of the challenge here can be the complexity of setting up that structure and the ability to scale it. And so there's been some fantastic examples across Asia where they're brilliant transactions with 5 or 6 different parties, and the scale of them relative to what we need to deploy to fix the problems is very, very, very small. So for me, part of the challenge here is how can we work more effectively, and how can we try and drive some more structured approaches to some of these areas where there's a proof of concept which can then be scaled. I'm a massive fan of a lot of the work that the IMF and AIIB and others are doing on this space as well. And I think that the sorts of frameworks such as HKMA's consultation on common ground taxonomy or implementation is providing a bit of an architecture for how some of these solutions could be put in place. The other element that I'm very positive on is that there's been a shift in institutional investor preferences from ESG integration as demonstrating a good ESG product towards a bigger focus on actually tangible outcomes and thematic and impact funds. So instead of saying, tell me how you've tilted slightly better towards companies within the investment universe, which is the integrated approach, it's saying, tell me what positive impact your dollars have had in the companies that you've deployed that capital into, and how is that attributable to a beneficiary or to an ultimate owner of the capital that you've deployed. And for me, that shift is really supportive of these sorts of catalytic capital investments, because it's very black and white, the positive that they can contribute. Part of what institutional investors can bring to this is almost the standardization of communication. And this is where the HKMA consultation and others and taxonomies and data sets start coming in terms of structured reporting, structured management, communication, and aggregation into investment products. So agree with you completely in that we know the direction of travel and what needs to happen. The complexity and those data and framework challenges, as well as the complexity of product creation, given the number of different parties, is still a bit of a barrier here. But it's something, if anyone is involved in that and wants to get in touch, I'm definitely very keen to have more conversations on it.
Well, on that note, let's go to the audience. We've got a fantastic panel here of experts. Who would like to ask these brilliant people a question? We've got one hand shot up over here, so let's go straight over here.
Hi, thanks, amazing panel for the session. I'm Winnie from Citibank. I have a question for Leslie, if I may. So Leslie, you mentioned like just energy transition partnership. There has been, several partnership initiatives successfully implemented, like in South Africa and some of the ASEAN countries. I'm curious, like from your perspective, what is the one thing that MDBs could start working on in order to make these just energy transition partnerships successful or more successful? Thank you.
Thank you very much. It's difficult to identify one single variable, but in my view, that has to be the need for significantly more concessional finance. So multilateral development banks have different windows, if you like. We have the World Bank in particular have a concessional window, which is essentially lending at zero interest rates, and in some cases even sort of subsidized rates. And then we have commercial loans. As banks, we are also profitable, and we are, the highest rated institutions, financial institutions in the world. But there's a very limited amount of concessional capital available. As we've just heard from Gabriel, for the institutional investor community to participate at scale in the sort of sustainability agenda, we have to look at de-risking, making it possible for them to meet their own risk return profile that is required from their shareholders and so on. MDBs can play a great role in facilitating and enabling that de-risking process. But in order for us to do it, we will need more concessional capital, because within the space of climate mitigation and climate adaptation, there are a lot of projects that are not really commercially that viable that would attract Amundi or Fidelity or any of the big institutional investors to get involved in. We need the development finance institutions to provide that initial capital that can unlock the broader flows from other providers of capital. So in short, my answer to you would be we need more concessional capital, and that unfortunately will require fresh injection of capital from the developed world, from European nations and so on. And there's a difficulty, especially in the post-COVID phase for, given the restrictive nature of the fiscal policies across the world, and because of the global fiscal crisis that we are in, there's a reluctance to look at new general capital increases of banks. So what would be the source of that concessional capital that I'm advocating we need is a bit of a tricky question.
So, Gabriel, you were nodding away there, agreeing with Leslie. So I just wanted to get he mentioned the likes of Fidelity. So what's the view from Fidelity on that?
No, I was nodding away because I just completely agree in that part of the challenge that a institutional investor will have is that there are a lot of projects which are undoubtedly have a very strong social good. And for example, climate adaptation projects, building seawalls around vulnerable communities, I don't think anyone would disagree is a bad idea. The challenge comes down to what return is available for that investment. And if it is purely based on the creditworthiness of the sovereign, then that may not be an appropriate risk-reward trade-off for an institutional investor. And so this is where project-specific finance or use of proceeds bonds with a different structure, which could either take a concession return for part of it to boost up the return for a private investor, or from others where there's different ways of approaching it, of bundling them together. So you take 10 projects and then aggregate them together to try and mitigate some of the risk from the individual exposure. There's a lot of different things that can happen on structuring to make it more attractive for institutional investors. But this is exactly that complexity point that I mentioned, in that it's not a straightforward plug and play like with a green bond, for example, that might be issued. So again, I think that it's a really exciting area where you've got the most tangible and attributable outcomes that you can point to. But again, there is a challenge around the fiduciary duty and what the investment community can do for broad funds, which, and this is, I make that distinction because you can have specific impact funds that are targeting concession returns on the private side or institutional side, but to move the bulk of capital, it has to meet an appropriate risk return, risk reward trade-off for our
They have to be investment products, right? At the end of the day, that's what we're talking about, creating investment products. Thank you very much for the question. Any other questions, please? Yeah, one right over here.
Thank you. Hi, it's Neka from Sustainable Fitch. I have a question for Gabriel. So you were talking about the SFDR and the dark green funds, which for those nerdy ESG people I know is the Article 9 fund. Have noticed that credit funds, particularly green bond, specific use of proceeds bond funds, have been more stable at the Article 9 level. So I'm wondering what your thoughts are about, in the interim before ISSB is widely implemented, are thematic or ESG-oriented equity funds more exposed to potential claims of greenwashing when there's a lack of consistent disclosure? I will respond in a technical way to the question, but apologies for general audience. So for an Article 9 fund, the core driver of downgrades to the Article 9 was the definition of sustainable investments and use of a proportionate calculation methodology, which effectively meant that once the EU Commission came out and said you had to have 100% sustainable investments in that product range, it basically precluded a lot of non-use of proceeds bonds and large cap companies contributing towards it. So that was the core driver of reclassification from Article 9 to Article 8. What that effectively means is that it was literally just a calculation methodology issue, is the short explanation of that. It's been resolved by a lot of people, and a lot of managers have shifted their approach to be more consistent with being able to achieve it. The benefit of a use of proceeds bond is that it creates if it meets international standards, if it's ICMA or other following in other standards, it's actually relatively easy to align it to the requirements under SFDR. And so it becomes a much more transparent way of meeting the criteria. The challenge with meeting it outside of that space is that there is no definition of sustainable investments. So every manager has to create their own framework. So we have our own framework based on SDG alignment, net zero achievement, good governance characteristics, and EU taxonomy alignment. But that is very different across different asset managers. So those funds will naturally be under more scrutiny for the integrity of the range and what's there, which is again to the point around which of these funds are more likely to get more questions or scrutiny. It's definitely where there's more subjectivity involved and that it's less arm's length transparent.
We might have to continue this one on the side because we're running out of time. But thank you for the answer. Got time for one more question. Yes, just here at the front, please.
Hi, I'm Paul Chan from Singapore. I have a specific question to illustrate the nature of some of the problem. We in Singapore have a haze problem that comes from Indonesia. In Thailand, there's a haze problem that comes from the north in Myanmar and Laos, because that's the fastest way to clear, and not to name who are the culprits. Question is, if the cost of not doing something is an externality on the health of people around, not any financial benefit, can you internalize that and make it a public good for certain sponsors or actors to get together to do that? Would that be something that could be done? In the pandemic time, we have governments subsidizing, making vaccination free. And so if there's a will, there is a way, I think.
So this comes back, I think, to the social thing that we were talking about a little bit earlier. Han, I don't know if that's something that you've considered.
Yeah, that's I would say the political will is always very, very important in solving all those things, like in the Hong Kong's case. And what is very, very critically important is we need a carbon price. And in order to really drive, the transition, the similar thing, I think in your cases, and I always say at the different levels and how this kind of, the partnership can be created. That's another issue. Political scientists always study in the different contexts. You need to create a different a mechanism in order to achieve those provision of the public goods. I don't think it's a Nobel Prize actual research projects. And basically, I would say I would agree.
But I just wanted to add to that, agree wholeheartedly with Han. But what COVID has done is remind us just how important it is to have institutions that can focus on challenges that are cross-border in nature, that cross national boundaries, whether it's climate change, whether it's lack of biodiversity. Everything you describe is exactly what multilateral institutions have been set up for. Way back in 1944, the World Bank was created, the IMF, and then many, many institutions after that. It becomes even more important today that we recapacitate these institutions to prepare us for the next era as we try to green our financial and capital markets towards net zero. You need dedicated institutions to deal with global public goods because governments do not have the incentive nor the resources to deploy their own national fiscal revenues to solve these problems. You need special institutions with the necessary skills, capacity, and resources to tackle these challenges like pollution and so on.
Thank you, Leslie. Just one final question from me before we run out of time. Our next two sessions are on family offices, ultra high net worth investors. And when we talk about mobilizing assets, there is a vast wall of assets that could be mobilized from the wealth management group, particularly maybe by the next generation of investors who are very much interested in sustainability and transition finance. So, George, maybe just quickly talk to us about the opportunity for high net worth investors or for people in transition finance to mobilize the assets of high net worth investors to apply them to this shortfall that we've been talking about.
Well, thank you. I think the COVID-19 pandemic, reminded us all that we need to work together with neighbors, right? No simple solution. But back here, family offices definitely are a new force to reckon with. I mean, in particular, second generation, whoever you meet, they will tell you, I'm a firm believer in ESG. And then they ask them, what do you invest in? We invest in green. And then they would add, green and growth can coexist and must coexist. So I think we need to mobilize that for sure. In Hong Kong and in Singapore, I'm sure, family office is a big component of our financial center ecosystem. And in China, the middle class is already more than 600 million people. And by 2030, will be more than double. I mean, anywhere like 800 million and more. This is very conservative. And all these people want to look into family succession, look into family office type of investment, and ESG, green, absolutely on the agenda. So I think before we know it, the Greater Bay Area is becoming not just greater in terms of geographical coverage or the fact that it got about 90 million people and growing. It's really global and green. And therefore, we need to engage the young people. We need to engage the family offices. And we need to engage all these SMEs, entrepreneurs, the founders of exciting businesses. So I think this is my view. And as I said earlier, we need greener and smarter solutions faster so that we can build back, faster, better from the COVID-19 pandemic.
Thank you, George. It's the middle of the afternoon session, so I'm just going to try a bit of audience participation to make sure you're all wide awake and paying full attention. Hong Kong has a goal to reach net zero by 2050. Put your hands up if you think Hong Kong will make that target. Put your hands up. If you're all too shy, everyone's going to report back that Hong Kong is not going to make its target. So I'll tell you what, I'll ask it the other way around. Put your hand up if you don't think Hong Kong is going to make its target to get to net zero by 2050. Okay.
Let's give Hong Kong a big hand.
Yeah, well done, Hong Kong. Thank you very, very much indeed to all my panelists. I'm going to hand over to my colleague Lily Zhu now for a focus on wealth management and ultra high net worth investors. If you enjoyed the topic of transition finance, OMFIF is doing a big event in Singapore in November on this very topic, and you'll all be more than welcome to join us there. But a big hand for my fantastic panelists. Thank you very much indeed, everyone.